Investors are always on the eye for the next big stock split that might be coming, and our MarketBeat analyst Thomas Hughes has a list of 3 stocks most likely to split in 2025. Thomas, let's start off with why do stocks split in the first place, and kind of what do you look for as an indicator a stock might be splitting?
The primary indicator really is the stock price. If the stock price is rising and persistently rising, then there's a good chance the stock is going to split, and that's because of accessibility. The company wants people to buy their stock, right? When it costs $500 or $1,000 per share, it's hard for average investors to buy it on a regular basis. You could easily misallocate your portfolio or not even have enough money to buy a share every month if it costs that much. I mean, that's a real reality. And more specifically, for their own employees, they want their employees to be able to invest in the company and feel that ownership, and they can't do it if it costs $1,000 a share. So when the stock price gets up to certain levels, you can expect a split to start being talked about, if not put on the table, because when a stock costs $100 versus $1,000, you can be sure that average investors will be able to buy them more and more regularly.
All right, well, let's get to your list, Thomas, of the first company you think has the strongest potential for a split in 2025.
Yeah, that's Netflix. Netflix stock price has been rising steadily over the last couple of years. It crossed above the 1,000 mark just recently. That puts it well in the zone where I would expect it to split. One of the things that's significant, research from Bank of America shows that stocks that split, do these forward splits, tend to outperform the S&P 500 by 2 to 1, which is very significant. And that's really not because they split so much as because of what's driving the stock price higher. And in Netflix's case, and in all the cases of these stocks, it's because of performance. Netflix is growing, it's outperforming, it's improving its user metrics, its cash flow is becoming more robust. Over the last year, it's paid down debt, it's brought its debt ratings up to investment quality, it's initiated robust share buybacks and capital returns. All of those things are playing into the stock prices rise. So I would expect, even if it does split, the stock price will continue to rise from that split level. And if it doesn't split, it could easily go to $2,000.
That is a hefty entry point for this stock, but it has been around for a long time. This would be Netflix's first stock split, right?
To my knowledge, it is. And that just kind of highlights the evolution of the company. It has evolved from an innovative market disrupting technology into a blue chip technology company with a sustainable, highly visible revenue stream, improving profit metrics, and improving capital returns, which are all part of a good investment thesis.
Well, let's move on to your second stock pick of a company you think is really primed to split yet this year.
Right, that's Costco. Like Netflix, this company is a blue chip growth company. It's market leading. It's been outperforming consensus estimates. It's been improving its cash flow. But most importantly, what Costco does is it has such a positive cash flow that it builds such a cash balance every few years. It's able to pay a special dividend. That special dividend is 5, 6 times the regular payout. It's on track to pay another special dividend in the coming year, and all of those factors are driving the stock price higher. Its stock price is also above $1,000, well in the zone where it could split. I would not be surprised to see it announce a split, very soon.
This company has just grown to really epic proportions very quickly in the retail space, especially. And it really seems like it's just because it's so innovative when it comes to retail.
Well, it is an innovator. It's consolidating value shopping. It's doing it in a way that attracts and resonates with its customers, and it offers many perks to its customers that keep them coming back.
Yeah, I know this very well. I go there a lot. I'm
Oh, do
I'm
you?
primary stock supporter right here.
Right,
I
right,
shop
right.
there way too much.
You guys eat a lot of Costco hot dogs,
Not so much the hot dogs, chicken for sure,
right?
and pretty much everything else. Let's move on to the third company here, Thomas, of a stock you think is ready to split in 2025.
All right, that's Meta Platforms. Meta Platforms, like Netflix, has evolved from this innovative startup, market disrupting technology into a blue chip tech company. Started 2 or 3 years ago with the year of efficiency. They really focused on operational quality that was compounded by the rise of AI. AI is not only enhancing its users' experience, but it's improving the company's internal metrics. So we've got user counts growing, we've got ad impressions growing, we've got revenue per ad impression growing, all providing leverage for the company's results. Those results include improving cash flow, robust free cash flow, and the initiation of capital returns this year. So like with Netflix, with Meta, we've got a fresh dividend and we've got share buybacks and expectation for distribution growth in the future. Buyback growth also to drive the stock price higher. This one is not quite up to $1,000 yet, but I see it getting there pretty soon. So if it doesn't announce a stock split, before that $1,000 level, I would say that once it reaches that point, the odds will grow significantly.
Now, you've been really bullish on this stock all of this year, and I want to get to why in just a minute. But first, take a look at this special report we have on the metaverse, on investing in stocks and companies related to Meta. You can scan the QR code or click the link in the description to get that free report on marketbeat.com right now. Thomas, tell us why you're so bullish on Meta for this year especially.
Well, right. I wasn't that thrilled with Meta back in the days when it was just Facebook. Since the year of efficiency, things have really changed. Operational quality has improved. The underlying business is sound and growing, and it's delivering some real value to investors. But more so, the company is using its cash to invest in advancing technologies. And in that regard, it's kind of evolving into more than a social media company and into something that more closely resembles a company like Apple. One of the developments that's happening right now is the virtual reality glasses with Ray-Ban. Sales of that product have been picking up, and this year could be a pivotal moment in which this product turns from being a novelty item to being a widely demanded consumer technology product akin to an iPhone.
Yeah, Thomas, you went into even more detail on why you're so bullish on Meta in our video on 5 stock picks for February. Meta was one of them, but he had 4 others too. If you haven't checked out that video, make sure to watch that one too. Thanks again for joining us today, everyone. And as always, happy investing.